Commodities investors tend to look at all commodities when oil is moving up, and usually most commodities move sort of not in lockstep, but in the same direction. Most commodities move up together and down together. Uranium has bucked that trend. Most commodities are down this year, and uranium is up, 70% year to date.
Welcome everybody to Capital Cosm. Today we have a special returning guest in the form of the Uranium Insider, Justin Huhn. Justin, thank you for coming back on.
It's my pleasure. Good to see you again.
Before we get started, though, nothing in this video is financial advice. Neither Justin nor I are financial advisors, so please do your own due diligence. Justin, let's go ahead and dive right in. Tell us what is going on in the uranium space at the moment. Uranium is currently sitting at about $81, broke through, I believe it's what, highs, 12-year highs since the Fukushima incident.
Yep.
So kind of walk us through there. What are some of the newest developments you're seeing in the uranium space?
Well, we've seen an enormous rise in the price of spot uranium. It's moved up probably about 45% since August, just in the last 3 months. And the interesting element to that is that we've seen declining volumes being traded in the spot market as the price has been rising. So that very clearly means this is a supply-driven price move, not a demand-driven price move. Demand has been consistent, especially in the term market, but the spot market, the volumes have been dropping. And they're not negligible volumes, but they are on the decline month over month. And yet we've seen a big move up in the price. Like I said, it's almost a 50% move in the last 3 to 4 months. It's a huge move for the commodity. The spot market specifically, and kind of the term market are both very thin. So we're seeing pretty big moves in the price on relatively small volumes. We've seen just a couple of weeks ago, we saw a multi-dollar jump in the spot price with actually zero pounds traded, just kind of some bids going back and forth and offers going back and forth without actually changing hands. And we saw the price move up just on that bidding. And so the Sprott Physical Uranium Trust has been buying a little bit of uranium, but not a huge amount of uranium. This hasn't been a financial markets driven move like the previous 2 large moves up. So March, April of 2022, September through November of 2021, those were big spikes in the price that were driven pretty much entirely by the Sprott Physical Uranium Trust buying hand over fist. Now they've been mostly out of the market for the last 12, almost 15 months. They've purchased, I think, maybe a couple million pounds over that entire period. But the price continues to move higher. So we have an entire industry now fully aware that we're in a rising price environment. This is a bull market with the commodity, and the pounds that are owned and potentially for sale are just being held more tightly right now.
Yeah. So you mentioned the supply. This is more of a supply-driven move. I want to ask you though, if you look at some of these charts, like Chemical are putting out, when you extrapolate forecast supply and demand out into the future, this thing widens even more and more to the 2030s and beyond. So I know like the last couple of uranium bull markets, they're pretty much kind of like not flash in the pans, but in a very consolidated small amount of time. With the way things are structured now, we have this huge supply deficit that's only getting wider. What's kind of like the extent that we kind of be looking at this bull market for? Is this really something that you think that might spike up in the next year or two, and then we just sell out, or just more of an extended cycle because of just the nature of the supply and demand deficit?
I do think it's going to be an extended cycle, but that's not to say that there's not a good chance of there being a price spike in the interim. The situation with the potential price spike is such, though, that spike itself is not going to solve the supply deficit. So the supply deficit is only going to be solved with new large greenfield mines. So, and potentially a ramping up of production in Kazakhstan and Uzbekistan. The Uzbekistan's production increase is more reasonable. They're producing 9, maybe 10 million pounds a year right now, and they're trying to get to 18 million pounds by the end of the decade. So, they're looking to have maybe a 10 to 15% expansion on an annual basis, which is decent. It's a pretty good jump. And I think they can get close to pulling it off and possibly pull it off. But with the Kazakhs expanding, what we're looking for really is to see CapEx increase and an increase in their wellfield development spending, because that has a 9 to 12-month lag on production. So we have yet to see any evidence whatsoever of an increase in CapEx. So what that means essentially is we believe that their 2024 numbers are not going to be hit, and they're probably going to come into the market in Q1 of next year and tell the market that they're not going to hit those numbers. That's a high likelihood of happening. But either way, if we look at a broader view of this decade, sure, we're going to have more production out of Kazakhstan and Uzbekistan. That's going to help. It's not going to solve the problem alone, but it's going to help. Really what we're talking about is NextGen's Arrow, Denison's Phoenix. Maybe we get 5 million pounds out of the US and a couple of other smaller projects, and Global Atomics DASA. All of these projects, and the US ISR can come on a little bit faster, but NextGen's Arrow, Denison's Phoenix, those are both claiming by the companies individually themselves that their first production is 2028. That I think is optimistic, but possible. DASA, same thing. That should be on sooner, but they're dealing with problems in Niger with the recent coup this past summer. So there's issues with every single project, whether that's a brownfield restart, whether it's a greenfield development project, or it's an expansion of an existing producer. All of these things are happening slower than the market, the uranium market and the industry would like to see them happen. So supply response is just slow, and it's problematic often. So what we're talking about really is 2028, 2029, maybe 2030 is when we'll actually see a market balance. But if the growth ends up being what it's projected to be, that balanced market will exist for a very, very short period of time. And from then on, we have depletion. We've got depletion in Kazakhstan. We have Cigar Lake basically done by the end of the decade, unless they go into phase 2, and maybe they will. It's a higher priced, lower grade phase of that mine. But we have depletion rates in all of the existing producers. So once we hit that quote unquote balanced market, that is likely to at least keep prices from moving higher at that point, and maybe slightly before that, if some of these companies do fulfill some contracting demand at reasonable prices. That remains to be seen. That's years away. But until then, we have a pretty severe supply situation. And I do think there's going to be a moment where we're going to see utilities actually competing for pounds. And that's something we haven't seen actually ever. That didn't happen in the previous bull market. There was a lot of contracting in the previous bull market. There was a pretty good amount of financial buying that drove a big price spike in the spot market, but we never really had utilities bidding up and competing for a dwindling supply. That's about to happen.
Yeah. I'm glad you brought up the prior bull markets. I know this chart here doesn't go all the way back to as far back as we'd like, but this is a supply and demand chart, and basically, you really start seeing the supply, the shaded area, which denotes supply, begin to diverge away from the demand case, whether it be base or the high case. But what's interesting is that if you look at in 2008, for example, at the height of the last bull market, supply and demand were pretty much even. Today, here in 2023, somewhere in this area here, I mean, we're still just about even when you compare it to the high case, or sorry, to the base case on the demand side. On the high case, there's a bit of a divergence, but the fireworks don't really start, to your point here, until you get to like 2030 and beyond.
Right.
And so, this is kind of like the basis of my question is that, if this forecast holds true and this thing keeps getting wider and wider, I mean, the uranium price basically has no breaks up until 2040, or somewhere in that ballpark.
Mm-hmm.
What's kind of your take on that?
Well, there's a couple of things. First of all, I think it's important to put this graph into context. So you can see in the lower left, the source is UxC's Q3 UMO. So this is a product they put out that actually digs into supply and demand, and knowing that it came from UXC counts inventory drawdown as supply. So when they show that base case for demand for this year, but it actually shows a tiny little sliver of light between the supply and demand. But really this year, from their own numbers, if you take out inventory drawdown, there's going to be a 30 million pound deficit in primary supply this year. So this shows a balance there on the base case. That high case has the difference between the demand base case and high case is not necessarily reactor life extensions, things like that. It's more like enrichment tails assumptions and inventory restocking and financial demand, financial buying. So that's really what puts the juice into that high case. And yes, the high case will be over time, that will include unexpected reactor life extensions. There's things like, will Germany turn any reactors back on? There's an independent team that went to Germany this year earlier that determined that 8 of their shut down reactors could technically be restarted if they wanted to. And now we're seeing a liberal party in Germany actually push for those restarts and things like that, right? Life extensions, restarts, a greater amount of reactors, new reactors being built, SMR demand, that's included in this high case. But the high case also includes substantially higher tails assumptions from enrichers, and it includes an inventory restocking, which is sort of an arbitrary target for individual utilities. They might restock more in a perceived supply deficit. So all of those things affect that demand high case and demand base case. But the other thing to look at this is the primary supply coming from UXC. So you can see that the primary supply actually grows, but the secondary supply drops and the overall supply barely grows going out to 2027. But UXC is also, to give them credit, they have been skeptical about the market doing what it's doing right now. So they've been relatively conservative in their forecasting and pricing. And a lot of that has to do with feedback they get from utilities, but a lot of it has to do with their own work. So they'll actually survey utilities a couple of times a year. And you can actually go back and look at a survey done earlier this year, and they'll ask the utilities, they'll poll the utilities, which are their customers, and say, where do you think the price will be in 2025, 2026, 2027? And basically 0 of the utilities expected the price to be where it's at now, even years from now. So the perception of the market, you can tell that the utilities really they're not in the business of timing the market and predicting prices. They just aren't. And that's difficult for the investment community to understand because that's what we do. But they don't. They buy uranium when they have to buy uranium, period, the end. They're not trying to time this market, buy low and try to save some money. That's just not how they operate. So, but UXC, again, to their credit, they are very, very cautious and skeptical about new projects coming online on time. And in some of their most recent publications of their weekly product, which we actually subscribe to, is basically they're saying, the spot market is very tight. The term market, especially in the midterm, is very tight. We're seeing a lot of RFPs in the market, and we don't expect that there will be supply to come in and solve this problem for multiple years. And I completely agree with them. And you can actually see that in the dark blue, the primary supply. I mean, where's Arrow and Phoenix and DASA and expansion of the Kazakhs? Like, that should be a big jump in that blue area. And yes, you can see that blue area expanding from 2022 out to 2028, but it's not a huge jump. So, and that shows their skepticism about the supply response. It's a serious problem, and it's going to get worse.
Yeah. So if I'm understanding this correctly, you're essentially underestimate, or they've essentially underreported the supply demand deficit in this chart because they're not accounting for a number of different items on the demand side, for example, and then on the supply side as well.
Correct. It's a little bit of a controversy in the sector, to be completely honest, because inventory drawdown does effectively act as secondary supply. If you're drawing down your inventories, you're not out there buying in the market, right? But it also is double counting. Both of those things are true. Those same pounds are counted when they come out of the ground. They count them again when they're drawn down as an inventory.
Right.
So whatever, some colleagues of mine who do very, very in-depth analysis on UXC's work basically say whatever they show, that inventory drawdown number or that plug number, that is the deficit. So, so what's not included in this graph is the inventory drawdown or that plug number. That number is the actual supply deficit, and it's big. You know, like I said, it's 30 plus million pounds this year,
Wow.
depending on a number of assumptions. Most importantly would be the enrichment tails assay assumption, but now we're towards the end of the year. We've known how much the financial buyers have purchased, which is significantly less than last year and the year before. But there's been some secondary demand coming from financials. There's been secondary demand from producers. We've had producers in the market buying this year. So we have a significant shortfall. And perhaps that green line is more accurate for this year. But even then, it's under reporting the actual deficit that exists in this market if you're not counting inventory drawdown as secondary supply.
Wow. So that's incredible. So essentially, if you can kind of extrapolate this green line all the way out, I mean, you're looking at around, what is this, like 100, almost 100, 200-pound deficit by 2040?
Yeah. And, it's hard to model out that far because nobody knows what's going to happen between now and then. Right. And a lot of that number is based on things like you have to do some kind of modeling of reactors that are planned, but the construction hasn't yet started on them. And those may or may not happen. But you also have to make assumptions on the production side. So the primary supply side, when they see it dwindling and dwindling and dwindling, they're not assuming that we're going to be at $120 uranium and every single project in existence will get built, right? Because that looks a lot better on the supply side if everything in Namibia gets built, and if everything in Australia gets built, the Uzbeks ramp, the Kazakhs ramp, the French get it going in Mongolia. The United States is producing, 5 to 10 million pounds a year. Canada expands. Like, if all of these things happen, we're going to have a much, much better primary supply picture. With all of that said, every project in the world, development project in the world, can get developed. But if we have the demand high case and we have, some of what is being discussed right now, like at the COP28 conference, where 24 countries are pledging to triple nuclear energy by 2050. Well, to do that by 2050 means you have to have an enormous amount of builds basically starting right now. It's a huge, huge expansion. And I don't know whether it happens or not. And that's what they're talking about happening. But if that happens, I can see a situation where we get into the mid 2030s and beyond, where we've got very high uranium prices. Who knows what that number is, but it's much, much higher than we're at right now. And there's just not going to be supply coming from mines to fulfill this demand. And we're going to need a lot of other solutions. And I actually really hope this happens, because I don't need this bull market to last for 15 years. Like, I'm happy if it lasts another 3 to 5, which I think it will. But more than that, I'm an advocate for nuclear, and I really want to see it expand on a global basis. And in order for us to have a sustaining nuclear industry, in my personal opinion, I think we're going to have to be able to get uranium from kind of beyond mining, let's call it. I think we're going to see seawater extraction, which may or may not be doable at $200 a pound. There's an insane amount of uranium in phosphates, and most of this exists in Morocco. You already have the United States and the Russians sniffing around Morocco. There's there's uranium in phosphate tails. The United States and China have a lot of phosphate tails. It's just uneconomic to have an extra process to pull them out. Who knows where else we can pull it from, but we're going to need additional supplies of uranium at some point. And most of these additional technologies, we just need sustained higher prices. So if we get into an environment where we're at $150, $200, maybe higher uranium, and it stays there, we're going to see the industry get creative to fulfill that demand. And that's when we're going to see a supply response that's going to stem the tide in the price, most likely, and keep it where that incentive price is for these additional technologies. Until then, when we have, and also laser enrichment, hopefully, at some point, that's going to be a decent supplier of uranium, as well as, just enriching with lasers tails from previous enrichment processes and conversion. So all of these things eventually will be needed, but until then, we have a big supply gap, probably for the next 5+ years. And there aren't any levers to pull besides perhaps Chinese inventory. And as of now, we have yet to see any evidence of them selling that inventory in the market. In fact, they've been buying, not selling, especially over the past year and a half. So the evidence as of now is they're building like crazy, building nuclear power plants like crazy. They're going to need that inventory. It's unlikely they're going to be selling it. But that is one lever that could be pulled if they have an incentive to keep prices from rising, or if they can, more importantly, replace those sold pounds with primary supply in abundant volume and at relatively low prices. So that's not the case, at least not right now. We don't think we see substantial inventories being sold into the market, and definitely not at these prices, because it's exactly the opposite is happening here.
Understood. Understood. I want to shift over to the impact that oil has, more specifically the price of oil on uranium. Oil has been dipping below $68 at the time of this recording. Does that portend anything to the uranium price at all, given that oil is a huge factor in the input costs that goes into pulling out the uranium, or is there typically no correlation between the two?
Historically, there's a little bit of correlation, but not a lot of direct correlation. I think that the price of oil largely has a lot to do with inflation, because it's everything is priced in oil,
Right.
essentially. I mean, almost everything. So to that extent, yes, higher oil prices, higher diesel prices affect the cost of mining, and that can affect the cost at which producers will sell it, and therefore increase the price of the commodity itself. That's true. I would say secondarily and indirectly, when the oil market is hot, it kind of stirs up the commodity investing group or community, for lack of a better word. So commodities investors tend to look at all commodities when oil is moving up. And usually most commodities move sort of not in lockstep, but in the same direction. Most commodities move up together and down together. Uranium has bucked that trend. Most commodities are down this year, and uranium is up 70% year to date. So it's unique in that way. So yeah, there's some correlation, but the uranium price really exists kind of in a world of its own. It's a very unique standalone industry. It's a commodity that cannot be replaced. It has no substitute. And regardless of what the oil price might do, we're going to see more pressure in the uranium price. But as far as inflation influences, that's definitely there. And perhaps with the equities markets, I think a true commodities bull will bring more money into the uranium space. And perhaps that's also what's kept the equities a little bit tepid this year. I mean, they've all done pretty well, all things considered, but compared to the commodity, they've struggled to keep up with the move of the commodity. And part of that, in my opinion, has to do with the performance of the oil market and other commodities markets, and then just in general, relatively subdued general investor sentiment that continues.
And probably less liquidity as well.
Right. True.
Yeah.
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 It's improving in certain securities, like the Sprott Physical Uranium Trust liquidity has been slowly improving over time. Cameco's liquidity is good. Some of the other large cap stocks are pretty decent, but yes, general market liquidity has been on the decline for sure.
Yeah, because if you look at stuff like URA, URNM, you'll notice that, interestingly enough, they tend to trace the NASDAQ and some of these tech sectors pretty closely. Not entirely, but definitely more than any other commodities in the commodity complex. So, to your point there, it not only is a commodity, but it's also kind of like a tech, not entirely a tech sector, but it has some overlap with the tech sector. So
Yeah.
liquidity, when you see liquidity dump into these tech names as well as crypto and so forth, uranium tends to move with them.
Yeah, it's really hard to say exactly where the flow of funds is coming from when it does move into the sector. I mean, when the price is moving up, we certainly see volumes improve, liquidity improve, but relative to the move of the commodity, most of the stocks in the space have been pretty subdued this year. But yeah, we've seen evidence of other markets affecting this market many times. Oftentimes that's in the negative, right? So we see like a blow up in the crypto space, you'll actually see some money being pulled out of the uranium stocks, just a general de-risking. When we have some sort of credit event in some other market, that can affect kind of everything a little bit. And we've seen that's definitely been the case in uranium. But we have also definitely seen some money rotating. We've seen the ETFs continue to increase their outstanding share count. The ETFs are buying, and they're buying not necessarily every day, but every single week there's buying. That over the past 3 months, it's been net buying by the ETFs. And the stocks have moved with it, but there, you can also see that there's some retail selling into this ETF buying. So there's definitely still a bit of subdued overall investor sentiment, I think. And, we think eventually that changes. And I think especially if the uranium price continues, we're at a really, really important psychological level here. Breaking through that $80 a pound level, I think was a big, big level. And now we're seeing if it's going to level off, if it's going to rest here for a minute. The interesting thing is that the volumes have dropped off in the spot market, but we're not seeing the price drop. So very, very, very tight market. And I think the price is definitely going to continue to the upside, and hopefully the equities will follow it.
Yeah, I just want to bring up this chart here because this illustrates institutional buying of URA, for example. So you'll notice here, back in September of 20 or whatever this was, September 2021, institutional buying was fairly measured. But as this URA price began consolidating down, you had more and more institutional buying, smart money buying, and right now you're actually at the highest peak that we've had for stretching all the way back to December of 2018. So
yeah,
the smart money is piling on to the uranium price, whether retail or not is to the same degree. Doesn't seem like it is, but there's positioning happening, and a lot of it started happening as soon as the equity started going down. So retail selling to institutions.
100%. That's a very, very astute observation. And you can look at some other evidence of this happening with just look at the performance of the large cap stocks. Large cap stocks are the liquid stocks, and they have pretty drastically outperformed the small and mid caps this year. That to me shows me that smart money is positioning, institutions are positioning. The selling pressure that's coming in the sector, in my opinion, is coming from retail. So it really takes kind of a retail frenzy to move these things in a big way. But to see, historically speaking, the ETFs, especially URNM, the Sprott Uranium Miners ETF, and probably even more so with the Junior Miners ETF, URNJ, they're majority retail owned. But that graph that you just showed an increasing in institutional ownership in the ETFs. We agree that's absolutely happening. And I think that the smart money knows what's about to happen in the sector. So eventually retail will jump onto that train in larger volumes, and we'll see some even bigger moves that can't be driven solely by the institutions.
Right. So I've got CCJ pulled up here. We know we're not that far off from all-time highs in CCJ.
Yep, it's true.
GEMCO. So, I mean, you look at this consolidation period from April 2022 up until this summer, we've broken up far and beyond the April 22 highs that the uranium equity saw in URNM, URA. So the large caps, i.e. CCJ, et cetera, these guys have already started moving. So this kind of dovetails into my next question then. There's different times as to when to buy certainly sized vehicles in equities, whether it be small caps, mid caps, large caps. In our case, explorers, developers, producers. It definitely does appear that the time to buy producers was back in May. Is that still the case, or has capital, is it more favorable for capital to flow into some more speculative positions, whether it be in the developers or even the explorers, which have been still largely beaten down?
Sure. Well, I mean, what we can really look at is historical moves in this sector, and that's on a couple of occasions around price levels. So that's the previous bull market. We're talking about 2005 roughly when it broke through these levels. It happened again after it came down from that price spike and started to recover before Fukushima. And what we saw around that price level, which actually inflation adjusted is about where we're at right now, is we saw the rest of the whole sector continued to move, but there was this shift in performance. And the first leg, coming from the bottom in the commodity up to about that $50 to $60 price range on those couple of occasions, not talking about when it just happened this year, but the previous occasions around that price level, which was 15 years ago almost, or actually more than 15 years ago, that was when we saw a pretty substantial outperformance by the small and mid cap developer and explorer stocks above the producers, the large cap producers. And that shift happened right around these levels, inflation adjusted. So we think that is what is going to happen, not just because of that historical evidence of the uranium market, but generally speaking, commodities markets, resource markets, what you usually see in a bull market for that particular commodity is the first moving stocks are the producing stocks, the large caps, the liquid names, and that's the smart money getting in the first few innings. That's what happens. So now what we've seen is a big reset in equities over the past 18 to 24 months. Yet the story has gotten way, way better during that period of time. And I think that the institutions are noticing that and setting themselves up for the next leg up in this market. With all of that said, also, we've seen a big outperformance of the ETFs in the uranium space and the uranium commodity this year. It certainly is sticking out like a sore thumb compared to almost everything. And that's going to get more and more institutional and retail attention as the market continues to move higher.
What makes you most excited at the moment right now for uranium?
I think what makes me most excited is the enormous amount of positive sentiment around nuclear itself. So, I do get a certain level of excitement, or I guess confidence in this investment by crunching the actual numbers about supply and demand. And that gives me a lot of confidence going forward for these next, 3, 4, 5 years, is recognizing there's just not a supply lever that can be pulled that's going to stem this. So that gives me a lot of confidence, but the excitement comes from the big shift around nuclear. And even if it doesn't mean anything in the near term for the commodity, it still is super, super exciting just to see kind of physics win and to see logic prevail and to actually see something that I think is hugely beneficial for humanity and for the world being embraced. And that makes me super, super excited for the future, just in general, not necessarily for the investment, but also for the investment. We have this wonderful story that's underpinning this commodity. So it's not just a speculation on a commodity going higher because of supply and demand factors, which you might do for, tin or nickel or lithium or whatever it might be. And maybe you're excited about the electric car, revolution or whatever. I'm not. But I do get excited about the growth of nuclear, just simply from a environmentalist or humanitarian standpoint. And I'm very happy to see that. Of course, it also coincides with my largest investment positioning, which is in the uranium sector, and certainly helps that story. But that excites me to see all the good momentum around it and see countries doing a 180 and re-embracing nuclear, and to see all of the excited attention around small modular reactors. And Poland just today announced they're going to build 24 GE Hitachi BWRX 300s at 6 different sites. Poland has the dirtiest grid in Europe, and they know it, and they're turning nuclear, and they're making deals with Westinghouse for large AP1000s and deals with GE Hitachi for these SMRs and some other players. So really, really gets me excited to see all that momentum in that positive direction.
Yeah, I mean, nuclear power is really the antidote against Malthusianism. You hear all this talk about an energy shortage, but the amount of energy, base load power that you can extract from nuclear energy just pretty much throws all of those arguments out the window. And it's I totally get your point there, to be being excited just for the very sake of humanity, to continue evolving, to believe in the ascent of man moving forward. What's your greatest worry in the uranium space?
I mean, I think my greatest worry is probably that there's a nuclear accident. That's probably my greatest worry. It's not something that can be predicted. It's not something I can control. But I admit I'm less worried about it than I used to be, because I understand more about nuclear. I understand more about the safety precautions in place. And, and every time there's an accident, just like, I don't remember who made this illusion. It might have been Mark Nelson. But basically kind of made an allusion towards comparing to the airline industry. Every time you have a major airline crash, a plane crash, you have a huge investigation that goes into what caused it, and you have the industry shore up protocols to make sure it doesn't happen again. Same thing with nuclear. That absolutely happened at 3 Mile Island. Chernobyl was kind of a, I don't want to say it was a one-off, but it was a unique situation because there was no containment around the reactor core. It's an old school Russian design, and there aren't reactors that operate like that any longer. So Chernobyl Part 2 isn't going to happen. 3 Mile Island actually contained the meltdown, and nobody was injured in that event, even though it got a lot of people scared because it was during the Cuban Missile Crisis era and the Cold War era. And then Fukushima, when Fukushima happened, absolutely every single reactor on the planet shored up all of their safety protocols, because that shouldn't have happened like that. The reactors survived that, what was it, a 9 point something earthquake? Is an absolutely massive earthquake. And all of the reactors in Japan survived that quake. But it was the tsunami that flooded the diesel generators that were below ground. So move your generators above where they can get consumed by water, period. And then Fukushima doesn't happen. So, every time these accidents happen, things are shored up. And then we've had all these little scares around the Zaporizhia plant in Ukraine in the past 18 months. And there's been fighting around the plant, and the plant's external power has been cut off a few times. And now it's a 6-reactor plant. It's the largest in Europe. 5 of those 6 reactors are basically in cold shutdown. The last reactor is minimally operating. So we've had about everything that could happen at that plant happen, and it hasn't resulted in a meltdown. And even if it did, it has containment domes. Not really worried about that. But of course, a nuclear accident, if it were to happen, would certainly hurt sentiment, probably hurt the stocks, at least in the short term. I'm not that worried about it actually hurting overall demand like Fukushima did. I don't think we're going to see the big nuclear operators and nuclear build-outs that are happening right now in the US, in China, India. I don't think they're just going to be like, oh, the meltdown that happened wherever it happened, sorry, just kidding, we're reversing course. I kind of don't see that happening. So I admit it's not a big worry, but it's one of those exogenous things that I can't predict. I can't model it out. And so it's out there, and that adds to the volatility of the sector. I think that there's always this risk that's out there, but knock on wood, hopefully it doesn't happen.
I'm going to throw a curveball at you.
Okay.
If you, what would you invest in if you couldn't invest in uranium right now?
I really like gold and silver here. And I do have investments in gold and silver. I'm holding some cash to buy what's hopefully a dip in oil. I think oil services stocks right now are cheap as of right now. And I think if we see a continued economic slowdown and oil drops even further, the stocks are going to drop even further. And I want to get aggressive into that when I think the bottom is in. So I'm holding some cash for that. I'm watching copper, but haven't done well with copper over the years. To be honest, I'm not very good at trading it. So I like the story. I think we're still in this electrify everything story, although I think it's losing a little bit of steam. And copper clearly is going to be needed in this quote unquote green transition that we all have supposedly signed on for. That's what I'm looking at now. So if I couldn't invest in uranium, I would, and if it wasn't an option, I'd probably have my money largely in precious metals stocks. I have some physical miners, streamers, and then I have some pretty aggressive options trades put on right now in the precious metal space. But the vast majority of my investable net worth is in uranium. I think it still is. I think it's the surest thing out there. And that's really saying something. I think it's the surest thing out there. I really don't see a situation where we see declining prices for the commodity. So hopefully the miners will largely still continue to move with it. Even if they move sideways on a relative basis, move just up with the commodity in lockstep, I think we're going to be happy campers there. But no uranium. Yeah, I would be precious metals, and I'd be holding some cash to buy an oil dip.
Gotcha. Where can my audience find you, Justin, aside from the Uranium Insider URL at the very top?
Yep, right on top of my head there. That's our website. You can find us there. I'm also on Twitter at Uranium Insider.
Awesome. Well, we'll have all those linked down below in the description box. Before we leave, any parting thoughts to the audience?
I think we covered things pretty well. I would say do what you can to keep up with the physical market, because that's going to dictate where things are going. As much as you can, make contacts in the industry, or sign up for a service like ours where we give you that information. Just try to understand what's happening there, because there's a lot of there's a decent amount of people who are fading this investment based on theories. So let's just say a theory that we will hit some arbitrary price level and we're going to see inventory flood into the market. It's important to recognize that that isn't happening. And will it happen? I don't know, but you want to be the first to know if it does, right? So you want to understand what's going on in the physical market. There's some other folks that are sort of out there trying to model out individual reactor demand based on some very strange assumptions. And while I applaud anybody doing any work, I think ignoring what's happening right now in the physical market, you're missing the most important thing. You're not understanding that we're seeing this price move on declining volumes. And that's very, very important, because it tells you how thin the market is. And so modeling out reactor demand, important. Making assumptions based on those models, also important, to get those assumptions as correct as you can, because there's a few that need to happen in order to come up with a number, especially tails assay. But actually knowing what's happening in the physical commodity trading market, you have to know that. So watch it closely. We're in the last few weeks of the year here. I'm not expecting fireworks in the next 3 weeks. The industry kind of goes to sleep in about a week from now. The last 2 weeks of December, it's usually pretty quiet. But 2024, I think, is going to be an absolutely spectacular year for uranium. This year is a perfect setup for 2024. Just like what you just highlighted with the institutional ownership of URA, that's across the sector, especially in the large caps, right? So SPUT, Cameco, NextGen, Paladin, Denison, and the ETFs. Those have all seen a lot larger and more institutions positioning in those vehicles this year. And that is leading up to what I think is going to happen next year, which is going to be kind of the year. This is going to be the year for nuclear and uranium. And I'm super pumped for it.
Fantastic. Well, that is uraniuminsider.com and Uranium Insider at X. So Justin, thank you for coming on again. If you enjoyed this content, be sure to like, subscribe, hit the notification bell icon, comment down below, do all the YouTube stuff I'm supposed to tell you to do. And with that said, I will see you in the next episode. Bye, y'all.